It's 8:30 a.m. on the first Friday of the month. The non-farm payrolls report drops, and instantly a 120 pip candle erupts across your screen. The headline number is a massive beat, showing the economy added thousands more jobs than predicted. You hit buy, expecting a surge, but your trade goes into freefall and your stop loss is wiped out in seconds. This happens because the US dollar frequently collapses even when the official report shows a booming labor market. High-frequency algorithms execute trades based on the raw headline before human eyes can even process the text. Reacting to the first number on your calendar places you directly in the path of these bot-driven spikes. To navigate the NFP release, we have to look past the initial reactive spike and adopt the chronological sequence used by institutional desks to track the specific data points that determine the market's true direction. Let's wind the clock back to 8:29 a.m., 1 minute before the data drops. This is when the market plumbing undergoes a fundamental shift called a liquidity vacuum. To avoid being caught in the volatility of the release, top-tier banks and liquidity providers pull their resting limit orders from the book. As the orders vanish, the trading spread explodes. What was once a fraction of a pip jumps to 20 pips. A 10-pip stop loss falls into this gap. With no orders to match, you suffer predatory slippage, getting filled far worse than intended. Institutional traders counter this by drastically reducing their position sizing. Since the average true range can triple during the release, they use a wider stop loss to give the trade room to breathe without increasing their total dollar risk. Using standard risk settings during this minute exposes the account to artificial spread widening managed by market makers who profit from the lack of resting liquidity. At exactly 8:30 a.m., the data hits the wire. High-frequency trading bots scan the report and execute trades in milliseconds. This creates an immediate, chaotic price spike based entirely on whether the raw headline job count surpassed expectations. But if we freeze the timeline, we can see the data the bots initially ignore. To find the actual growth of the economy, we have to look at the historical revisions. A positive headline for the current month is frequently neutralized by a quiet, severe downward revision to the previous month's data. To find the true market trajectory, we add the current headline to the previous revision. If the revision is larger than the beat, the net change for the labor market is actually negative. This mathematical reality explains why price often reverses. The initial spike does not reflect the full scope of the report. Beyond the number of people hired, a second data point frequently overrides the total job count, average hourly earnings. In the current economic climate, markets often prioritize wage growth over the headline hiring figure because of its impact on service sector inflation. This architecture represents the Federal Reserve, which monitors wage growth to determine interest rate policy. If people are being paid significantly more, it suggests persistent inflation. However, if the report shows that job growth is high but wage growth is falling, it signals cooling inflation. This gives the Fed room to eventually cut interest rates, causing the dollar to weaken. In a higher-for-longer era, cooling inflation data can permanently offset the impact of strong hiring, dictating the currency's actual direction after the initial noise. Now we move the timeline to 8:45 a.m. The initial 15-minute algorithmic whipsaw has concluded, and the retail stop losses have been cleared. This is when institutional trading desks have finished digesting the net revisions and the wage data, moving the market based on the full economic context. Professionals use this window to identify the institutional fade, a strategy of trading against the initial bot-driven spike once the actual data reveals a different story. Look at the 15-minute candlestick chart. If the price spikes up, but the candle closes with a long upper wick near a major resistance level, it confirms that institutions are fading the move. The first 60 seconds of the NFP belong to high-speed algorithms, but the sustainable trend that follows is driven by the human logic of institutional desks. Success in the NFP release requires following the actual data narrative rather than the headline. Download the FXNX NFP checklist to track the next release and trade the institutional pivot on the NX1 platform.